Imagine, for a second, watching your favorite sports franchise break their all-time scoring record, win the championship, and then the very next morning, they go out and sign 3 of the most expensive free agents on the market.
Right. It's just a completely staggering amount of action all at once.
Exactly. It's aggressive. And as an observer, or, in your case as an investor, you really have to take a step back. You have to figure out if the underlying reality actually matches the sheer volume of hype they're generating.
Yeah, because the risk profile of that franchise, or in this case, the company, completely transforms when management makes moves of that magnitude.
Spot on. And that is the exact situation we are unpacking today for you in this brand new deep dive. We are looking at Patria Investments Limited, ticker symbol PPAX. We're cutting through the corporate jargon to analyze their Q4 and full year 2025 earnings call.
And this is a firm that didn't just beat its own records. I mean, they fundamentally altered their corporate identity in a matter of months. The top-line growth they reported is undeniably staggering.
But the real intrigue, the mission for today, is looking at how they are doing it. We're breaking down the headline numbers, the M&A spree, and management's guidance to see what this means for anyone holding or looking at the stock.
Right, because we are watching Patria aggressively shift away from their historical identity as a traditional private equity firm. They are pivoting massive amounts of capital into permanent structures.
Specifically private credit and real estate, right?
Right.
And they are doing this while navigating a really unique macroeconomic landscape in Latin America.
Exactly. A landscape that's currently presenting some highly unique structural advantages. The headline numbers give us the result, but it's the architectural changes to their business model that reveal the long-term strategy.
So let's just start right there with those headline numbers, because the organic growth alone alters the trajectory of the firm. They reported a record $7.7 billion in organic fundraising for 2025.
Which is just a massive beat.
It really is. To put the scale of that into context for you, their initial target, which they laid out at their investor day in late 2024, was $6 billion.
Right. And then by the third quarter, they saw the momentum, so they revised that target upward to $6.6 billion.
And they still blew past that revised target by over $1 billion. And they raised that $7.7 billion entirely in-house, without even relying on the assets they acquired from other companies later in the year.
Yeah, pulling in that level of capital organically, it's a massive stress test of their distribution network. And they clearly passed. I mean, this is only year one of a highly structured 3-year plan to raise $21 billion cumulatively by 2027.
So surpassing their year one goal by $1.7 billion basically front loads their success, right?
Exactly. It provides an immense operational cushion going forward.
And that influx of capital pushes their total fee-earning assets under management, or AUM, to $40.8 billion.
Yeah.
That is a 24% jump year over year.
But you have to look at the pro forma numbers, too.
Right, the pro forma numbers, which include the massive acquisitions they announced in Q4 that are still closing those, put them at $47.4 billion in fee-earning AUM right now.
And their stated public goal is to hit $70 billion by 2027. So suddenly, staring down $47.4 billion today makes that $70 billion target look, far less like a pipe dream.
It looks much more like a mathematical probability at this point.
Exactly. So the focus then really has to shift from the sheer volume of assets to the quality of the revenue those assets actually generate.
Yeah, let's translate that for the listener, because in the alternative asset management space, Wall Street heavily scrutinizes 2 distinct profitability metrics: fee-related earnings, or FRE, and distributable earnings, or DE.
Right. And for 2025, Patria's FRE hit $203 million, which is a 19% increase.
And their DE came in almost identically at $200.9 million, which translates to $1.27 per share. But let's break down the mechanics of those 2 metrics.
Yeah, because understanding the difference between FRE and DE is basically the entire key to valuing a company like Patria.
So FRE is effectively the firm's base salary. It is the recurring revenue they generate purely from management fees. Usually that's somewhere around 1% of the total assets they manage.
Right. As long as the capital is sitting in their funds, they just collect that fee.
And Wall Street values FRE incredibly highly because it is so predictable. Analysts can model it out 5 years into the future with high confidence, which is exactly why public markets often assign a 20x or 25x multiple to fee-related earnings.
Yeah, that predictable nature of FRE is the absolute foundation of the firm's valuation. Distributable earnings, on the other hand, Well, that represents the total cash available to distribute to shareholders.
Right. DE is essentially that FRE base salary plus the performance fees.
Exactly, what they often call carry. It's what the firm collects when they successfully sell an asset for a profit above a certain threshold. Those performance fees are the bonus check.
But they are inherently lumpy, right? Like a firm might sell 3 major infrastructure assets in 1 year and realize massive performance fees.
Yeah, and then they might go 24 months without a single major exit. Because DE includes these unpredictable spikes, the market assigns a much lower multiple to it, usually closer to 5x or 7x.
Okay, so while DE tells you the total cash generated this year, that 19% growth in FRE tells you that the structural recurring health of the business is expanding rapidly.
Precisely. And the earnings transcript actually spends significant time emphasizing the permanence of that FRE base. Management noted that 90% of their fee-earning AUM is locked up in vehicles with no or highly limited redemptions.
Wow, 90%. And even more crucially, 22% of it, so roughly $9.1 billion is in what they call permanent capital.
Yeah, and if I'm an investor looking at the volatility of emerging markets, seeing 90% of the capital locked up means the firm is effectively immune to a traditional bank run.
That's a great point. Like if a macroeconomic shock hits Brazil or Mexico, retail investors and mutual funds might panic and withdraw their money.
Right, which instantly vaporizes the management fees for a normal firm. But in Patria structures, the capital literally cannot simply flee.
The lockup periods in private markets are basically the ultimate defense mechanism against human psychology.
Exactly. In a traditional private equity drawdown fund, the institutional investors, the limited partners, they commit their capital for 8, 10, or sometimes 12 years. They can't call that money back just because the local stock exchange had a bad week.
And in permanent capital vehicles, like publicly traded real estate investment trusts,
right,
the capital never leaves the firm at all, right?
Right. The investors who want to exit just have to sell their shares to another investor on the open market. Patria continues to manage the underlying assets and collect the management fee regardless of who actually holds the shares on any given day.
So this structural stickiness practically guarantees the FRE will be generated year in and year out. But that actually brings up a fascinating contradiction in their guidance.
Oh, the 2026 fundraising target.
Yeah. If the capital is that sticky, and if they completely crushed their 2025 fundraising goals by pulling in $7.7 billion, why did CEO Alex Saig issue 2026 fundraising guidance of just $7 billion?
It does seem incredibly counterintuitive, doesn't it?
Right. I mean, setting a target for next year that is $700 million lower than what you just achieved. My immediate reaction was to wonder if they are seeing a massive slowdown in institutional demand.
Like they're trying to lower expectations before the market realizes the momentum has stalled out.
Exactly. Are they just sandbagging to easily beat the numbers next year, or is there a genuine fear there?
Well, the analysts actually pushed the CEO on that exact discrepancy during the Q&A portion of the call. His response detailed the internal operational friction of raising capital faster than you can responsibly deploy it.
Oh, okay.
Yeah, when an alternative asset manager raises $7.7 billion in 12 months, the primary existential threat to the firm shifts from a lack of capital to a phenomenon known as cash drag.
Right, because institutional investors don't want to pay management fees on cash that is just sitting in a bank account earning the risk-free rate.
Well, actually, it's precisely the opposite problem. The limited partners are paying Patria to generate high-yield alternative returns.
Oh, I see.
If Patria sets a fundraising target of $9 or $10 billion for 2026, the pressure on their internal investment teams to deploy that capital becomes immense.
And when investment teams are under pressure to just spend money, underwriting standards inevitably slip.
Exactly. They might overpay for a logistics asset or accept a lower yield on a private credit loan just to get the money out the door.
That makes total sense. So by holding the 2026 target flat at $7 billion, management is instituting like artificial scarcity.
Right. They are signaling to their own deal teams that they do not have to lower their return hurdles just to deploy cash. It's an exercise in pacing a marathon to ensure the returns on the 2025 capital actually materialize.
Okay, but you don't get to $70 billion in AUM just by pacing your organic growth. To bridge the gap from the high 40s to 70 billion in 2 years, they have to buy the actual infrastructure of the market.
And the fourth quarter saw an absolutely aggressive deployment of capital to do exactly that.
Yeah, let's look at what they bought. They bought 51% of Solace, which is a Brazilian private credit manager with $3.5 billion in AUM.
They also acquired a suite of real estate investment trusts from RBR, bringing in $1.3 billion in permanent capital.
And then they moved into the U.S. market by acquiring WP Global Partners. That's a lower middle market private equity manager with $1.8 billion in AUM.
And in a really massive pivot, their energy trading platform, Tria, is acquiring Raízen Power to become one of the largest independent energy trading desks in Brazil.
It's like playing Monopoly and buying up all the utility and railroad properties at once. But the M&A strategy here seems highly targeted toward building scale in specific verticals.
Verticals where size dictates pricing power. Yeah. Let's examine the RBR acquisition for a second. By pulling those REITs under their umbrella, Patria is now the single largest manager of listed REITs in Brazil.
Sitting on a pro forma AUM of $5.7 billion in that asset class alone.
Right. And in the real estate sector, scale creates a self-fulfilling cycle of dominance.
The mechanics of that dominance are critical. I imagine being the largest player means you basically dictate the terms to the market.
You absolutely do.
Like, if a major developer in São Paulo is building a massive logistics park and needs a buyer, they don't call the firm with $500 million in AUM. They call Patria because Patria has the immediate liquidity to close a $200 million transaction.
Exactly. That first look advantage on deal flow means Patria gets the premium assets before they ever hit the broader market.
And on the liability side, having a $5.7 billion portfolio allows them to negotiate significantly lower interest rates from the major banks when financing these properties.
Which directly increases the yield they can pass on to their investors. But the management team highlighted a highly specific, localized advantage of their massive REIT platform.
Oh, right. Providing liquidity for wealthy Brazilian families navigating inheritance and succession planning.
Yes. In Brazil, these listed REITs are known as FIIs, or Fundos de Investimento Imobiliário. They trade daily on the B3 stock exchange.
The mechanics of how they use these FIIs to solve inheritance problems is honestly one of the most brilliant strategic plays mentioned in the call.
It really is. Walk the listener through that.
Okay. Consider a wealthy patriarch in Brazil who owns a $50 million portfolio of physical commercial buildings. When that individual passes away, the heirs face an absolute nightmare.
Because the probate process in Brazil is notoriously slow, right?
Exactly. Plus, the estate taxes, the ITCMD must be paid. And most importantly, you cannot easily divide a physical office building among 3 children.
Right. If one child wants cash to start a business and the other 2 want to hold the building for rental income, the family is just stuck.
Yeah, the illiquidity discount of trying to sell a massive commercial property quickly is severe. And the friction of that illiquidity is exactly what Patria is monetizing.
It's brilliant. So they approach these high net worth families and offer to acquire the physical buildings, but instead of paying cash,
Patria issues the family shares in their massive, publicly listed FIIs. The physical real estate is absorbed into Patria's portfolio, increasing their fee-earning AUM.
And in return, the family receives $50 million worth of highly liquid, divisible shares. So the child who wants cash can literally sell their third of the shares on the stock exchange the very next morning.
While the 2 children who want income can just hold their shares and collect the tax-advantaged monthly dividend, Patria is essentially acting as a liquidity bridge.
Using their massive scale to solve a deeply emotional, highly complex legal problem for their wealthiest clients.
And once that wealthy family is holding Patria shares, they are in the ecosystem, making them prime targets for cross-selling. But if we pivot from their LATAM dominance to their U.S. acquisition, the strategy gets a bit more complex.
You mean WP Global Partners?
Yeah, they purchased WP Global, a lower middle market private equity firm in the U.S. My initial reaction to this was pure skepticism.
How so?
Well, Patria's entire competitive mode is built on 40 years of localized expertise navigating the political and economic intricacies of Latin America. Buying a firm that invests in middle market healthcare in the American Midwest seems like a massive dilution of that core competency. Doesn't that dilute their moat?
Diluting the moat is definitely the primary risk when an emerging market specialist expands into the most competitive financial market on earth. The U.S. lower middle market is completely saturated with capital.
Right. So why do it?
Well, the transcript reveals that the WP Global acquisition is actually a defensive mechanism. It's designed to protect Patria's Latin American client base. This falls under their Global Private Market Solutions, or GPMS division.
Okay, I think I see where this is going. If I am a billionaire family office in Colombia or Chile, and I have half my wealth managed by Patria and local infrastructure and credit, I eventually hit a concentration limit.
Exactly. You need geographic diversification, specifically into U.S. dollars and U.S. assets.
And historically, that family office would have to take their capital out of Patria and hand it to a massive U.S. firm like Blackstone or KKR to get that exposure.
Yes. So by acquiring WP Global, Patria builds a direct pipeline. They can now construct customized feeder funds that take that Latin American capital and route it directly into their own in-house U.S. private equity products.
Oh, wow. So it internalizes the capital flight?
Yeah.
The wealthy Latin American client gets the dollar-denominated U.S. diversification they require, but Patria continues to collect the management fees on both sides of the border.
Exactly. And furthermore, WP Global has an established network of U.S. institutional investors.
Meaning, Patria now possesses a domestic U.S. distribution channel to market their high-yielding Latin American products directly to American pension funds.
Right, bypassing the need to build a U.S. sales force from scratch. It's a two-way street.
Okay, so the final piece of the M&A puzzle is probably the most unconventional. TRIA acquiring REITs in power. We are talking about an asset manager buying an energy trading desk.
It sounds wild, but when you look at the mechanics of the Brazilian energy market, the vertical integration makes total sense.
Because Brazil is transitioning into what they call the free energy market, right? Where commercial consumers can bypass state utilities and negotiate their power contracts directly.
Exactly. And Patria already manages massive infrastructure funds that literally build and own renewable energy plants like solar and wind farms across Latin America.
So the synergies are entirely mechanical here.
Sure.
If Patria's infrastructure fund owns a massive solar array, the traditional model requires them to sell that power to a third-party utility.
Who then resells it to a factory, capturing a massive margin in the middle.
But by owning TRIA, one of the largest independent trading desks, Patria can route the power generated by their own physical assets directly through their own trading platform.
Capturing the middleman's margin and offering customized long-term power purchase agreements to their corporate clients.
It completely transforms Patria from a passive financial sponsor into an active participant in the physical economy.
It really does. But look, this level of aggressive expansion requires a massive macroeconomic tailwind to sustain it. And management spent considerable time detailing the structural shifts putting wind in Patria's sails.
Yeah, let's unpack that macro story. Because the data shows that Latin America broadly outperformed global capital markets in 2025.
Which is a dramatic narrative shift. I mean, for decades, institutional capital viewed Latin America as a tactical high-risk trade. You jump in when commodity prices spike, and you flee the moment local politics get volatile.
But now the capital is becoming structural. It's flowing in heavily from Europe, the Middle East, and from deep within the local LatAm pension systems.
And the drivers of that capital flow are highly mechanical, beginning with the yield curve.
Right. Inflation in key Latin American economies has fallen significantly, which has allowed their central banks to initiate aggressive interest rate cutting cycles well ahead of the U.S. Fed.
We really must look at how falling interest rates alter investor behavior here. When local government bonds are yielding double digits, domestic pension funds and high net worth individuals have zero incentive to take on the risk of a private credit loan or an infrastructure project.
Right. The government just pays them handsomely to take zero risk.
Exactly. But the moment the central bank cuts rates and those bond yields compress, the math breaks down.
Because a pension fund still has actuarial requirements, right? They must hit, say, an 8% return to pay their retirees.
Yes, and if the safe bond only yields 5%, they are forced to move further out on the risk spectrum. They have to allocate billions of dollars into higher-yielding alternative assets like Patria's funds just to survive.
So the local central banks cutting rates acts as a massive involuntary marketing campaign for alternative asset managers.
Precisely. And these internal interest rate dynamics are compounded by massive global supply chain realignments.
Yeah, management noted the geopolitical realities driving foreign direct investment into the region. Global manufacturing is actively seeking alternatives to Asian supply chains, which is heavily accelerating nearshoring in Mexico.
Simultaneously, the global energy transition requires massive quantities of critical minerals.
The geopolitical angle is really the ultimate catalyst here. The lithium triangle across Chile, Argentina, and Bolivia holds a massive percentage of the world's known lithium reserves.
Plus, Brazil is an agricultural superpower and a massive producer of clean energy.
So the capital flowing from the Middle East and Europe isn't just chasing yield, it is securing supply chains for rare earths, copper, and food security.
Exactly. And just to note, management mentioned that more market-friendly governments in the region have stabilized the fiscal outlook, allowing this long-term capital to feel secure.
Yeah, and look, we're just impartially relaying the corporate viewpoint here from the call, making no political endorsements either way. We're just reflecting how they see the fiscal prospects. But it is clear they view the region's transition into a strategic geopolitical necessity as their primary growth engine.
The macro story is incredibly compelling, but it immediately invites scrutiny regarding the single largest risk factor in emerging market investing.
Currency depreciation.
Exactly. Local yields can be spectacular, but if the underlying local currency devalues by 30% against the US dollar, the real return for an international investor is just wiped out.
Yeah, the historical volatility of currencies in the region is the primary reason US allocations often lag. I mean, is the market pricing in the inherent risks of currency fluctuations?
Well, the defense mechanism Patria has engineered against this currency risk is vital for any investor modeling the stock. The CFO revealed a critical piece of data. Over 60% of their fee-earning AUM is denominated in hard currencies.
Wait, 60%?
Yeah.
Predominantly the US dollar.
Yeah.
That is a shockingly high percentage for a firm fundamentally built to invest in Latin American assets.
It is. And the mechanics of that dollar denomination dictate the firm's resilience. Patria raises billions of dollars from international limited partners, sovereign wealth funds, Canadian pension funds, institutions in Europe.
And those funds are legally structured in offshore jurisdictions, right? Like the Cayman Islands or Delaware.
Exactly. And the commitments are made entirely in US dollars. Patria's management fees, their FRE, are calculated as a percentage of those dollar commitments.
Oh, I see. Therefore, even if the Brazilian real or the Colombian peso suffers a massive, sudden devaluation, Patria's revenue stream on that 60% of their AUM does not budge.
Right. The limited partners absorb the localized currency risk on the underlying assets, but Patria's corporate balance sheet is heavily shielded.
That's a crucial risk mitigation strategy for investors to understand. But look, despite the macro tailwinds, the currency shields, and the aggressive M&A, the earnings call was not without significant friction.
No, it wasn't. The Q&A session exposed a major vulnerability in their legacy business.
We have to talk about the problem child, the performance of their older private equity funds, specifically Funds 5 and V, which are pre-2016 vintage buyout funds. The analysts pressed management hard on the valuation of these funds, and the numbers are bleak.
Very bleak. Fund V is actively what they term falling out of carry.
And the immediate financial impact was a violent contraction in their total net accrued performance fees. It plummeted from $402 million in Q3 down to just $249 million in Q4.
Wiping $150 million of expected future revenue off the board in a single quarter is a massive red flag.
We really need to translate the Wall Street jargon here. What does falling out of carry actually mean?
Yeah, it requires a detailed understanding of how private equity waterfalls function. The performance fee, or carry, is not earned on the first dollar of profit.
Right. The fund must clear a specific return threshold. The hurdle rate before the general partner, Patria, is entitled to a percentage of the profits.
Furthermore, these funds operate with high watermarks. If the overall value of the fund's assets declines below that hurdle rate, the firm loses its right to the performance fees it had previously expected to collect.
So if Fund V holds a mixture of private companies and publicly traded late-M stocks, and the local stock market takes a hit or the currency depreciates, the total net asset value of the fund drops.
Exactly. And the moment that value dips below the hurdle rate, Patria must reverse the accounting entries for the performance fees they had been accruing. The money they modeled out for future bonuses just vanishes.
Now, the CEO mounted a highly technical accounting defense regarding this drop.
His defense was entirely structured around cash flow realities versus accounting projections. He detailed their valuation mechanics. Private assets are valued once a year using independent appraisers who build discounted cash flow models.
Right, projecting the future cash flows of the portfolio companies and discounting them back to present value, checking them against current public market multiples.
But the CEO's core argument was that the $150 million drop in accrued carry was an off-balance sheet event. unrealized performance fees do not run through the profit and loss statement.
Because the accounting reality is that Patria only recognizes performance fees when an asset is physically sold and the cash is deposited into the firm's bank account.
Exactly. Employees do not receive bonuses on unrealized paper gains. They only count cash in the bank.
Therefore, the CEO is correct that this $150 million reduction does not impact their 2025 earnings per share by a single cent. It is merely a reduction in their theoretical future backlog.
Wow.
However, looking at the structural evolution of the firm, I have to form a thesis here. Consider this hard truth. Patria's oldest foundational core competency is traditional private equity.
And the pre-2016 environment in Brazil was brutal. They were dealing with a massive recession and the Lava Jato corruption scandals. Those vintages suffered.
Right. But if their flagship funds 5E and V are struggling to the point where management is projecting literally zero new performance fees from them in 2026, we have to ask a tough question.
Which is?
Is this massive pivot into private credit, REITs, and infrastructure actually just a rescue mission? Are they aggressively building these new verticals to mask the fact that their legacy private equity engine is dead weight?
That's a very valid concern. The data definitely supports the thesis that they are aggressively diversifying away from a struggling core asset class. A bad vintage can drag a firm's reputation down for a decade.
Yeah, so what's the counter argument?
Well, the transcript counters the idea that the entire private equity division is dead weight. Management specifically pointed to the success of their newer iterations of private equity, specifically their growth and venture funds.
Oh, right. They cited the exit of Avenue, a venture asset sold to Itaú, which is one of Brazil's largest banks. So the newer strategies are generating realized returns.
Exactly. And their forward guidance still projects $120 million to $140 million in performance fees over the 3-year plan. They are just sourcing those fees from entirely different vehicles.
They explicitly stated that Infrastructure Fund Third is now the primary engine expected to generate their 2026 performance targets, with roughly $20 million modeled from that single fund.
The firm is evolving away from traditional Ladamon buyouts, which are highly sensitive to local GDP growth, and heavily weighting infrastructure and credit, which generates steady cash flows regardless of the broader economic cycle.
So balancing the incredible growth in credit and infrastructure with the drag of legacy private equity, what is the bottom line reality for shareholders? We need to look at the cash, the buybacks, and the boardroom shuffle.
Yeah, the financial engineering currently taking place at the executive level indicates massive confidence in the cash-generating ability of this new diversified model.
First off, we are seeing significant executive turnover at the exact moment they are integrating billions of dollars of newly acquired companies.
Right, some housekeeping. CFO Anna Russo is stepping down to take on advisory roles, passing control to Rafael de Nadal in April 2026.
And simultaneously, they created a new global chief operating officer position, recruiting Nikitas Filakis from DWS Group, a German asset manager that oversees nearly $1 trillion.
Before we look at the execution risk of that new team, we have to look at the balance sheet they are inheriting because it is getting a massive cleanup.
Yeah, management announced a legal victory that results in an 85% reduction of a $100 million litigation liability.
Which is huge. That liability is coming off the books in early 2026. Instantly removing an $85 million dark cloud from the liability column frees up massive amounts of theoretical capital.
And the board is highly aggressive about returning capital to the shareholders. They approved an additional 3 million share buyback program. They increased the dividend by 8% to 65 cents per share for 2026.
But the strongest signal in the entire document is the insider buying.
Right. The partners of Patria, operating through their holding company PHL, announced their intent to personally purchase up to 2.5 million shares on the open market.
The mechanics of insider buying at this scale provide a vital data point for valuation. The partners already control roughly 60% of the outstanding shares. Their personal wealth is overwhelmingly concentrated in this single asset.
When executives who already hold a controlling stake use their own capital to purchase millions of additional shares on the open market, it is basically the ultimate put your money where your mouth is indicator of perceived undervaluation.
Absolutely. Executives sell stock for a myriad of reasons. Tax liabilities, estate planning, diversification. They buy stock for only one reason. Their internal DCF models indicate the public market is heavily mispricing their future cash flows.
And the cash flow math? presented by the outgoing CFO, validates that confidence. She projected the firm will generate roughly $220 million in cash during 2026.
And from that $220 million, they will pay out $100 million in dividends. They will pay down their deferred M&A costs from all these acquisitions. And they will also cover the cash requirements for their total return swaps.
Let's pause and actually explain the mechanics of a total return swap, or TRS, because it is a vital tool for how they execute these share buybacks without draining their immediate liquidity.
Yeah, it's pretty clever. If Patria wants to buy back $50 million of their own stock, they could simply use their cash reserves. But they want to preserve that cash for future M&A. So they enter into a TRS with a major investment bank.
How did that actually work under the hood?
The bank uses its own balance sheet to purchase the $50 million of PACA stock on the open market. Patria agrees to pay the bank a floating interest rate, usually SOFR plus a spread, for the duration of the contract.
Okay, so if the stock price goes up, the bank pays Patria the profit. If the stock price goes down, Patria owes the bank the difference.
Exactly. It is essentially executing a share buyback on margin. Eventually, Patria physically settles the swap, taking delivery of the shares and retiring them.
So the TRS mechanism allows Patria to lock in the current stock price and reduce their share count without tying up tens of millions of dollars in upfront cash.
Precisely. And even after funding the dividend, the M&A costs, and the TRS obligations, the CFO noted they still project having excess cash on the balance sheet at the end of 2026.
Alongside $100 million in completely undrawn debt capacity to fund future growth.
Right. Their guidance points to fee-related earnings between $225 million and $245 million for 2026, scaling to between $260 million and $290 million by 2027.
Crucially, they expect to maintain an FRE margin between 58 and 60%. But look, maintaining a 60% profit margin while executing this much M&A introduces massive execution risk.
Yeah, it does.
I mean, you have a new CFO taking over, you have a newly hired global COO. They have integrated $8 billion of M&A over the past couple of years, and they're currently closing on a credit firm, a U.S. private equity firm, A&D, an energy trading desk.
Who is watching the store while the old CFO leaves, right?
Exactly. The operational friction of merging different software systems, aligning compliance across U.S. and Brazilian regulators, and harmonizing distinct corporate cultures is monumental.
A single failure in risk management at the newly acquired energy trading desk could severely damage the parent company's balance sheet.
So how do they mitigate that?
Well, the operational complexity is the single largest threat to their 58% margin guidance. This is precisely why the hiring of Nikitas Falakis as global COO is the most critical executive move.
Because by recruiting from DWS Group, Patria is acquiring the operational blueprints of a trillion-dollar manager.
Exactly. They are openly acknowledging that the localized boutique infrastructure that scaled the firm to $20 billion will fracture under the weight of a $70 billion multinational operation.
So the new COO's mandate is not deal-making, it is standardizing the plumbing, the data architecture, the reporting metrics, the compliance firewalls.
Right, to ensure the M&A spree actually generates the modeled synergies rather than creating operational chaos.
That brings it all together beautifully. The narrative of this earnings call reveals a firm attempting to fundamentally outgrow its own history.
The results paint a picture of a company aggressively evolving.
They really are. The data shows Patria ruthlessly pivoting away from the volatility of traditional Latin American private equity buyouts. They're using massive macro tailwinds, falling local interest rates, and global supply chain shifts to vacuum up capital.
They are locking that capital into permanent vehicles like REITs and shielding it by raising funds in U.S. dollars.
And they are buying the underlying infrastructure of the financial markets, from U.S. feeder channels to energy trading desks, becoming a cash-generating machine.
It's an incredible transformation.
It is. And it leaves us with a final provocative thought to chew on today. As alternative asset managers like Patria blur the lines of what they actually do, moving from just buying companies to launching energy trading desks and managing public REITs, do they stop being traditional investment firms?
Are they mutating into quasi-banks or financial utility companies that own the literal and financial plumbing of the economies they operate in?
Exactly. And if so, how does the average investor even begin to properly value them 5 years from now? The traditional metrics might be entirely insufficient to understand the sheer economic power they wield. Keep diving deep, and we'll catch you next time.